Okay, so I'm going to move now to the financial section of our business plan. And I'm going to introduce the structure of the financial plan. If you think about where we have been so far, what we've covered so far. So in the what we can call product market fit section of the business plan, we have learned to tell a story about our product and our company that is compelling for investors. The story goes like this. We have an innovative product. It solves a painful problem for customers. These customers are part of a fast-growing market. We have an effective strategy to enter this market, to reach these customers with a compelling message about our value proposition, to distribute our product and sell our product profitably to these customers. And we have the ability as an early mover in this market to create barriers to entry for followers through both intellectual property barriers and strategies that create barriers to entry. And we have the best possible team to execute this strategy. That's our compelling story on the product market fit part of our business plan. But that's only half the story. Now we need to tell the second half of the story, which is about the financial plan. Because investors are not investing in our company just because it's a great product market fit. They're investing in our company because they believe that the fact that it's a great product market fit also makes it a great investment. So now we have to go tell the second half of that story. And we're going to tell the second half of that story. Why is our startup a great investment? Through the financial section of our business plan. And the financial section of business plan also must tell a compelling story. And the compelling story is highlighted in the sections of the financial plan that I have listed here. But before I go through the structure of the financial section of the business plan in more detail, I want to just briefly discuss which is more important, a good product market fit or a good financial plan. So if I have to choose as an investor between those two, which should I choose? Now, what would that choice look like in real life? I can reframe that choice this way. Let's say I have a startup where I really believe in the product market fit in the business plan, but the financial plan has some fatal flaw. So should I invest in that company anyway? Meaning, should I invest in the company solely on the basis of the product market fit and not worrying about the fundamental flaw in the financial plan? I think that this is a question over which investors may disagree. So some investors might say, doesn't really matter what's in the financial section of the business plan or what's in the financial plan. If the product market fit is good, then we should make this investment. And why might they think that? They might think basically the information in the financial section of the business plan is nonsense, especially for early stage startups. Because why? Because there's tremendous uncertainty in what's going to happen to an early stage startup over the next 5 to 10 years in terms of its financial results, and therefore nothing that we say in the financial section of the business plan is likely to come true, and therefore we shouldn't really worry about it too much, and let's just focus on the right product market fit. So if we have the right product market fit and the investment side, the financial side doesn't seem to work, let's not worry about that too much. I disagree with that view. I believe that we need to take very seriously the financial section of the business plan, and that in the case where I really like the product market fit, but I feel that there's a fundamental flaw in the financial plan, I would rather not invest than invest. Now, in order to understand that, we need to maybe at this point look at an example of what might be a fatal flaw in a financial plan, because there are different kinds of potentially fatal flaws. Let's look at one specific fatal flaw from my perspective that actually I see a lot in Southeast Asia is the valuation of the company is too high. So let's say the valuation of the company is too high. I like the rest of the business. Should we still invest? Again, there's two sides to this argument, so let's look at both sides. The argument for why I should invest in the company that I like, even if the valuation is too high, is that if the company has a successful product market fit, slight variations or even relatively small variations in valuation now won't matter in the long run. Why? Let's take an example. Let's look at, let's start with my required return from an investment. Let's say my required return on investment in seed stage is 30 times my original investment. And let's then look at investment that's valued at $2 million versus $5 million. And let's say those are post-money valuations. So if the valuation I think is fair is $2 million, the company wants $5 million, should I invest in that business? If I want to argue that I should do that anyway, I would argue this way. I need 30x return on that business. If the business is later sold for $1 billion, it doesn't really matter whether I value at $2 million now or $5 million now. If I value at $2 million now, I make 500x return. At $5 million, I make 200x return. Both are way higher than 30x return, and therefore no need to worry about small variation in valuation now. Even though this is actually, the 5 million valuation is actually 2.5 times the 2 million valuation, so it's small maybe in dollar amount, but not small as multiple. So, okay, that's one argument. But my argument goes like this. Actually, if this company is successful, and especially in Southeast Asia, we're not going to sell for $1 billion. The probability that this company is going to be sold for $1 billion is vanishingly small. The overwhelmingly high probability is if this company is ever sold, it'll sell for somewhere around $100 million. If it sells for somewhere around $100 million, then the difference between valuing at $2 million and $5 million is very important. Because why? If I value at $2 million and we sell at 100, I make 50x, which is above my 30. And if we value at 5 million and even make it to 100 million, we sell at 20x, which is below my 30. So that's why I think we need to be very cautious about investing in businesses where we believe there is a fatal and not correctable flaw in the financial plan.